In Chapter 4, we go through and we talk about individual income tax in an overview perspective. We describe the formula that's needed for calculating an individual's taxpayer's tax due or tax refund. We go through and discuss the requirements that are needed in order to determine who qualifies as a taxpayer's dependent. And then lastly, we discuss the taxpayer's filing status. The first video that we'll do today is an overview of the individual income tax formula. The objective is to help you understand the big picture. Many of the things we're going to talk about in this first video are going to be discussed in more detail in later chapters. The second and the third videos dealing with dependents and filing status, you will need to know these videos in depth, as this is the only time we will cover these technical details. They will not be covered later on elsewhere in the text. You'll want to make sure you have a good understanding of dependents and also a good understanding of the different filing statuses that are available for a taxpayer. So let's get started with our first video. The individual income tax formula is responsible for reporting a taxpayer's taxable income. And a taxpayer's taxable income is reported to taxpayers and to the IRS on our Form 1040. There are some variations of Form 1040. For example, sometimes taxpayers file a Form 1040-EZ, which is an easier, more simplified version of the Form 1040. In this class, we're going to concentrate on the Form 1040 because it is the form that's generally used to report taxable income. Now, in your textbook, you'll find in the textbook an exhibit that includes the tax formula. And this is the tax formula that we're going to go over in this video. We are always going to start with our gross income. This is all income that the IRS has determined to be taxable. We'll then subtract our 4 AGI deductions. We call these above the line deductions, and that equals adjusted gross income. Adjusted gross income is an important number, not just for tax purposes, but it's a number that's used for a variety of other things, such as student loan applications, applications to get a residence for mortgages, and a variety of different areas use your adjusted gross income. Adjusted gross income is also used later on in the tax return calculation to determine things like the amount of your itemized deductions and also the amount of credits that you get. So the AGI is an important number on the tax return. After we calculate our adjusted gross income, we'll then subtract our from AGI deductions. These are considered to be below the line deductions. The first below the line deduction is going to be the greater of the standard deduction or the itemized deduction. And then now under the new tax law, we also have a new from AGI deduction, which is the deduction for qualified business income. We'll spend more time talking about that a little bit today, but also in a later chapter. That gets us to taxable income. We'll then use the tax rates, which we learned how to use in Chapter 1, to calculate the taxpayer's income tax liability. Then taxpayers will add in other taxes such as self-employment taxes and they'll get to their total amount of tax. They'll then subtract out their credits and their prepayments, and they'll come down to the tax amount that's due or a refund. This formula is important for you to know. This is the basis for the 1040 and will also be the basis of what we file, what we use when we calculate all of the tax problems that are working to determine the amount of tax refund or taxes due. So let's take a look at how we'll use this formula in a problem. Let's go to the first problem for Chapter 4. And this first problem for Chapter 4 says that David and Lily Fernandez have determined their tax liability on their joint tax return to be $1,700. They have made $1,500 of payments. They also have a child tax credit of $1,000. What's the amount of their tax refund or taxes due? Okay, so when we work this problem, we're going to use the tax formula to work this problem. So we'll start with the total tax liability, which was given to us in the problem, which is $1,700. We'll then subtract out our credits, which was a child tax credit of $2,000, and we'll subtract out our prepayments, which was a prepayment of $1,500. This tells me that this couple is going to get an $1,800 refund. Again, so we use the tax formula in order to determine the amount of tax due and the amount of tax refund that's available to the taxpayer. Now let's dig into more detail about that tax formula. So we're going to start by looking at the very top of the tax formula where we talk about the idea of gross income. And when we talk about the idea of gross income, the first thing that we need to go through and talk about is we need to discuss the concept of realized income. Now, when a taxpayer talks about realized income, the IRS defines realized income as all income that is considered to be received by the taxpayer. I like to say that the IRS says that all income is realized income. All income is realized income. Now, some income is considered to be excluded from the tax law. And the income that is considered to be excluded from the tax law are called exclusions. And exclusions are things such as our tax-exempt income, which will include things such as interest income on municipal bonds. It also will include gifts and inheritances. So anytime a taxpayer receives a gift or an inheritance, it's excluded. And then it could include the gain on the sale of a personal residence. Most of that gain is also excluded. So all income is realized income unless the income is excluded from the IRS, and that income that's excluded is considered to be tax exempt. Now, some income may be considered to be a deferral. When income is considered to be a deferral, then that simply means that the income is not currently taxable, but that it's taxable later. So some examples of deferrals include things like installment sales, and also include things like like-kind exchanges. In the textbook, they include a really nice exhibit that shows you the different kinds of exclusion or deferral items. So you can see here are the first three that I talked about. Interest income from municipal bonds are excluded. Gifts and inheritances that are received by a taxpayer are excluded. Gains on the sale of personal residences are also excluded. You can also include in there life insurance proceeds. Those are also excluded. And then here's the two deferral items that I discussed that are deferred. That simply means it's not taxable right now, but will be taxable later. Now, when we talk about income, we've identified that all income is included unless it's excluded or it's deferred. The other thing that we need to know is we also need to understand the character of the income. Character of the income is important because it determines which tax rates the taxpayer is going to use to determine the amount of tax. So the first type of character of income that we have is ordinary income. Ordinary income are things like our salaries, our business income. Those are all considered to be ordinary income, and they're taxed at ordinary rates. Now, the second type of income is considered to be capital income. Capital income comes about from selling a capital asset. An important term in tax world is the term capital asset, and you'll have to know what a capital asset is on the exams. So a capital asset is any asset except for accounts receivable, inventory, and business assets. So what is a capital asset? A capital asset are all personal assets. They are also all investment assets like our stocks and our bonds. If you sell a capital asset, we have to determine whether it's long-term or short-term. A long-term asset is sold in over 1 year. You've held the asset for more than 1 year. A short-term asset is an asset that you have held for less than 1 year. I should say an asset that you've held for 1 year or less. If an asset is long-term, it's generally taxed at the tax rates of 0, 15, or 20%. The breakpoints for the different rates are based upon a taxpayer's income. Right now, you don't have to worry about those breakpoints. We'll discuss that later. Short-term capital gains are taxed at the ordinary rates, which are the rates that are given to you on the tax rate schedule. Now, when we have a capital asset, if we have capital losses, there's special rules that apply to capital losses. When we have a capital loss is only deductible against capital gains. And then you can deduct up to a maximum of $3,000 against ordinary income. So let me show you a little example here. Let's say we have a long-term capital gain of $10,000 and we have a long-term capital loss of $15,000. So what I'll do is I'll net that together and I have an overall $5,000 loss, long-term capital loss. Of that $5,000, only $3,000 can be used against ordinary income. So that means that I can take it on my tax return in the current year and I can decrease ordinary income, such as my salaries. So you might say, well, what happens to the other $2,000? Well, the other $2,000 in this example is carried over to future years. So I'll be able to take it in the next year if I have capital gains and ordinary income. So the important thing to remember about capital losses is that they're only deductible against capital gains, and you can only deduct up to $3,000 of a loss against ordinary income. If you aren't able to use all of your loss, you can carry any remaining amount over, any excess loss, to future years. And that loss can be carried over indefinitely. Now, the last type of income that we have is we have our dividend income. So we've talked about ordinary, we've talked about capital, and now we're going to talk about our qualified dividend income. Qualified dividend income is income that comes as a dividend that's designated as qualified. For right now, you don't have to worry about what makes the dividend qualify. It'll be designated as qualified. If it's a qualified dividend, it's going to be taxed the same as our long-term capital gain rates. So that'll be 0, 15, or 20% tax rates. It's dependent upon the taxpayer's income as to what rate it's taxed at. Okay, so that's the different characters of income. Now let's go through and let's talk about our deductions. Before we do that, though, I want to point out a great exhibit in the book that shows you the different types of income items and whether they're ordinary or capital or qualified dividends. So you can see that most of our income is considered to be ordinary income, but that some income is considered to be capital, taxed at those lower rates, and some income is considered to be qualified dividends, also taxed at those lower rates. Okay, let's refresh where we're at in our tax formula. So we have talked about our gross income, and now we're going to go in and talk about our deductions. The two types of deductions that we have are for AGI deductions and from AGI deductions. So let's start with our for AGI deductions. So deductions allow taxpayers to reduce their gross income. The first type is called a for AGI deduction. We refer to this as an above the line deduction, and we mean line as in the AGI amount. So remember, in that tax formula, we take gross income minus 4 AGI deductions equals our adjusted gross income. So it's above the line. Now, in the book, they provide you with an exhibit of all of the common for AGI deductions. So some common AGI deductions: alimony paid if it's prior to 2019, health insurance paid by self-employed taxpayers, rental and royalty expenses. There's our capital losses limited to $3,000. Self-employment taxes, business expenses, losses on trade or business, contributions to qualified retirement accounts. Remember, right now you just need to know some common for AGI deductions. We're going to spend a whole chapter talking about deductions and going into more detail about the different deductions that are available to taxpayers. The other type of deduction is our deduction from AGI. Now, our deduction from AGI is called our below the line deduction. We call it below the line because we calculate our adjusted gross income and then we subtract our from AGI deductions to calculate our taxable income. There are two types of below the line deductions. The first is going to be the greater of the standard deduction or the itemized deduction. The standard deduction is an amount that's set by the IRS. The itemized deductions are a variety of different kinds of deductions, and the taxpayer will pick the larger of those two items, the standard deduction or the itemized deduction. In your book, you'll see the standard deduction provided to you and also a variety of different itemized deductions. Let's talk about the standard deduction first. The first thing you'll note is that in this video, I'm using the 2018 standard deductions. If you're watching this recording in a different tax year, you'll need to find the standard deductions in the textbook for you. These standard deductions will also be given to you on the exam. They'll be given to you on the exam so you don't have to worry about memorizing them. The other thing to note is that notice in 2017 to 2018, the standard deductions got significantly bigger, and that was because of the tax law changes that were made in 2017. So here's the 2018 deductions for you. The next thing you'll see in the book are the itemized deductions. The itemized deductions include things such as medical and dental expenses, taxes, interest expense, gifts to charity, and some other miscellaneous deductions. Remember, right now, you don't need to worry about the details related to these itemized deductions. We're going to spend a whole chapter talking about the itemized deductions later. So that's the first type of deduction from AGI. It's the greater of the standard deduction, which is set by IRS, or the itemized deductions. The second type of from AGI deduction is a new deduction that's made new after the 2017 tax law changes, and it's a deduction that's allowed for qualified business income. A deduction that's allowed for qualified business income. It is a deduction that allows the taxpayer to take a deduction that's equal to 20% of their qualified business income. We will talk later about what is determined as qualified business income. Right now, all you need to recognize is that this is a deduction from AGI, and it's going to be equal to 20% of qualified business income. Okay, let's look at the second problem to take a look at this new deduction. Okay, in the second problem, we have Cameron. He's received gross income of $120,000. For December, Cameron is considering whether to accept one more engagement for the year. And in that engagement, the engagement will generate $7,000 of revenue at a cost of $3,000, which is deductible for AGI. In engagement 2, the engagement will generate $5,000 of qualified business income, which is eligible for the 20% deduction. Okay, so let's see how we can calculate this. So Cameron files as single. Okay, so what they want to know is they want us to determine our taxable income from each engagement, assuming that he chooses 1 and 2. Okay, and it says that he has no itemized deductions. Okay, so again, we're going to use the tax formula for that. So let's look at engagement 1 first. So under engagement 1, the first thing we're going to start with is we're going to start with a gross income of $120,000. Okay, then we're going to add in under engagement 1, they're going to generate $7,000 of revenue, and it's going to have a cost of $3,000. So we're going to have net of $4,000 there. We'll add that together to get to my AGI. My AGI will be $124,000. And then what I'm going to need to do is I'm going to need to take out the greater of my itemized deduction versus my standard deduction. So we're going to use 2018 numbers, and he's single. So the single amount's going to be $12,000, and it said that he did not have any itemized deductions. So we're going to take out the standard deduction of $12,000. And then we'll get taxable income of $112,000. Okay, so that's engagement number 1. So now let's look at engagement number 2. Under engagement number 2, for that engagement, we're going to start with the $120,000. But in this scenario, we've got $5,000 of business income. So I'm going to add that $5,000 in, and I'll get AGI of $125. No expenses on this one. We'll then take out the greater of the standard deduction or the itemized deduction, which is $12,000. And then now it says that in engagement number 2, it was eligible for the 20% QBI deduction. So we'll take 5,000 at 20%, gets me to a $1,000 QBI deduction, and it gets me to the same amount, $112,000. Okay, so see how in this example, in engagement 1, he only made $4,000 here, right? Net, and came out with the same amount of taxable income. In engagement number 2, he received cash of $5 net and came out with taxable income of $112. So that will help us answer question number 2, which says, which engagement maximizes Cameron's after-tax cash flow? Okay, so both engagements generate the same taxable income, right? The $112. However, engagement number 2 produces more net cash flow. And the reason why is, remember, in engagement number 1, we only got $4,000 net in cash. In engagement number 2, we got $5,000 net in cash. So engagement number 2 is better than engagement number 1. You should choose engagement number 2 over engagement number 1. Okay, let's continue down through re-looking at, let's go back to our tax formula, and let's go back and look at that tax formula again. Okay, so we again started with our gross income, all income considered to be taxable unless it's excluded or deferred. We subtracted out 4 AGI deductions, things such as our health insurance for self-employed taxpayers, our business expenses, our rental expenses, self-employment taxes. We got to adjusted gross income. We then subtracted out our from AGI deductions, which is the greater of the standard or the itemized deduction, and also our new deduction for qualified business income. That got us to our taxable income. In our taxable income, you go through and you take the taxable income and you use the tax rates schedules, which remember we talked about in chapter 1. Those are these, okay, to calculate out your taxable income. Then after you do that, you're going to also have to include some other taxes. Some taxpayers might have some other taxes. These might include alternative minimum tax and our self-employment tax. We will cover both of those in a later chapter. We'll get our total tax amount, and then we will subtract out our tax credits. Tax credits reduce the taxpayer's tax liability. We would rather have a tax credit than we would have a deduction, because a tax credit reduces the amount dollar for dollar of taxes due. We also will subtract out our prepayments. Prepayments could include things such as income taxes withheld by the taxpayer's employer. It could also include estimated tax payments that the taxpayer made during the year. Once we subtract out the tax payments, then we're down to the amount of taxes that is due. Or, if the taxpayer is lucky, the amount of tax that's a refund. Okay, so that's our overview of the tax formula. Remember, for this chapter, you need to know broad-based understanding of the tax formula. In later chapters, we're going to go into each of these areas in more detail.